2024 will be another deficit, and they imagine 215 million ounce shortfall, second largest in more than 20 years, fourth year in a row of a structural deficit. Of course, the supply demand numbers do not put in military usage, and that's a big deal for me. When we go back to the congressional hearings, Senate hearings, subcommittee hearings in the 40s that I've talked about, I've shown you, that talk about needing 200 million ounces of silver per year in the 40s. Well, we've talked at length about the need for silver in high-tech weaponry, and those supply-demand numbers that the Silver Institute publishes, right or wrong, will tell you there's a 215 million ounce deficit on the horizon for this year, the fourth year in a row, but they don't mention anything about military. So my guess is those numbers are much, much higher, and this is why you have 8 brain-dead banks holding the price of silver down.
With a 215 million ounce silver deficit looming in 2024, the second largest in over 20 years, banks are holding massive short positions to keep prices artificially low. But here's the twist. These numbers don't even account for military demand, making the real deficit much larger. India is importing silver at a staggering rate, with a 260% increase month over month, while the West is distracted. Meanwhile, China is buying up silver from Latin America in unrefined form, avoiding market detection and bypassing Western price controls. This is a setup for a massive price explosion, and the consequences for these banks could be catastrophic.
All right, now going to India, it was just reported August 23rd that India's silver imports are on course to nearly double this year, and they're going to double to, the country has already bought 2,295 tons compared to only 673. This was in February alone. In February, 1 month, and they published these numbers months after. In 1 month, they bought 2,295 tons of gold in February, and that's up from 637 tons in January. So you're talking a 260% increase month over month. That's massive amount of silver. Putting that in perspective, okay? That amount of silver that they bought in 1 month is 70 million ounces more in silver than the U.S. Mint made in silver eagle coins over the past 3 years combined. So you got India importing more silver in 1 month than the U.S. Mint has made in eagles in 3 years combined. Think about that for a moment. They are estimating that upwards ends of 7,000 tons will be imported this year. And I mean, last year it was 4,554 tons and 560 tons the year before. So 560 jumps up to 4,554, jumps up to 7,000. Their numbers are massive, and they've imported over 700 million ounces in the last few years. That's so much more than is on COMEX and LBMA combined for delivery. It's not even funny. And that's just what they tell us. And as I mentioned to you probably last week in an interview I did with Sean Kunkun from Dolly Varden, he says, look, Andy, China's flying all around Latin America and buying up all the doré and concentrate and shipping it back to China to refine it. How many people know that China is the second largest producer of silver in the world, and now buying concentrate and doré at up to twice what the West will pay for it, shipping it home and refining it, so it doesn't have the transparency or affect the price settlement the way that it would coming off of an exchange? You have these countries using the brain-dead Western suppression against us, draining the exchanges, making massive deliveries across the globe, and now even disintermediating the whole system and going right to the miners and buying their doré. So it's a big deal. I mean, I don't know how much bigger of a deal than I can explain it than to say these countries are every bit as sophisticated or more so than the West. And in fact, they know what we're doing, and we've documented that on all sorts of things that they've said, like the head of the Shanghai Exchange in 2015 saying, when China is allowed to speak at the gold table, the real price will be observed, or the BRICS Grain Exchange saying we produce more grain than the West, but we can't control the price. It's done on COMEX. That will change now with the BRICS Grain Exchange. They know what we're doing to the world's commodities. They know we're suppressing them. So instead of raising a fuss about it, they're just draining it and buying it everywhere and anywhere they can, even in unrefined form. And it goes right past the watching eye of the mainstream. It goes right past the watching eye of Wall Street. And you got to come to Liberty and Finance to find that. it's just a joke. But it elevates what we're talking about to supreme importance, because you can't get out of the way of what you don't see coming. And in this case, you can't take advantage of what could be a once in a generation shift unless you know it's shifting. And indeed, by the actions of these countries, it's shifting. The amount of deliveries that we are seeing is so unprecedented, it's not even funny. And it will get to a point where at some point, the exchanges that have grown to be accepted for up to 140 years, the LBMA and the COMEX since 74, will be rendered the same way Bernie Madoff was, as a scam and as a Ponzi scheme. And the Shanghai Metals Exchange, which has increased over 200% in volume in the past several months, has now surpassed in trading volume the COMEX. So these little by little moments are becoming far more legitimate, and it baffles me how underestimating this is really, how the mainstream underestimates it, how Wall Street underestimates it or completely ignores it. I think this is a massive deal, a huge deal, and all you got to do is not listen to what people are saying, but do what the biggest money in the world is doing, those who know the playbook, and that is accumulating commodities, period. Selling treasuries, selling dollars, getting out of the way of what's coming, and buying commodities which have, as we know, no counterparty risk when held in your own possession. You know, just in the numbers that you mentioned, from quarter one 23 to quarter one 2024, that's about 130% increase. And that goes to show that the transferring of these liabilities to insurance companies is a byproduct of the environment of uncertain economic times, inflationary pressures, geopolitical pressures, stupidity of our leadership, the end of the era of low interest rates, perhaps. I mean, we're not ever going back to zero bound. If we do, this country's dead. But you know, these are the quandaries that are facing these pension administrators. And you're right, they typically will give those pensions to insurance companies. And you know, I think it becomes very concerning to me when you realize that, you know, these insurance companies are loaded with things like treasuries, and what happens to their ability to AIG was a reinsurer, if I'm not mistaken, and they reinsure the insurance companies. They're the ones who are insuring the insurance companies because it would lead to a systemic failure if rates were to spike, as we've talked about before, if all of a sudden the dollar was dumped, Operation Sandman, or they end up saying in October, we're going to issue the unit like we've talked about. It's not just in theory and in principle, but it's real. And now the need to hold dollars in treasuries wanes and they get dumped. And so the Federal Reserve is the only one dumb enough to buy them, which leads to hyperinflation. But this is the kind of nonsense that these pension administrators are thinking about. And it becomes a little concerning when you realize that all of these annuity contracts are issued in a small number of insurers. And you're talking about massive systemic risk, where, you know, you got a handful of the very biggest insurers who are, yeah, I'll take this huge lump sum. That's amazing. And I'll take on your liability. Well, why do you think the pensions are getting out of it? Because the actuarials and the numbers that they've used really don't, you know, they're concerned about going forward. People are living longer and it's harder to you know, go out into the future and to make these returns and to feel safe about guaranteeing them. So they're offloading the liability to the insurance companies and washing their hands of it. But, you know, when we talk about insurance companies in the United States, I don't know how many have failed in the last 20, 30 years, but the number's got to be close to 100, I would think. Insurance companies fail too. And in a rising interest rate environment, when you see these companies have been loaded or are typically loaded up on treasuries, in an environment where treasuries are becoming more dangerous, this whole thing, it's a powder keg. It truly is a powder keg waiting to happen. And I just think it's wise of these companies to offload this responsibility. But I think it puts a target on the insurance industry and makes the insurance industry one that is, again, arguably very over-leveraged and undercapitalized to maintain these lofty expectations. And if something happens in the economy that disrupts their normal course of business, what happens to all of these pensions? Does this go bye-bye? I'm not sure, but I think that it you know, when people have the choice, they're either given a lump sum or an annuity. Well, with a lump sum, now you're forced to managing it yourself. And all of this money you thought about for retirement, you now have to manage. Yeah, you could put that into gold. But now you have the quandary. It used to be you knew your retirement was safe and secure and you were set. And now you're thinking, geez, I got to manage this myself. I don't know how to do that. What am I going to do? Do I put it in bad things? Do I put it in the stock market right before a crash? Don't know. Or I can get an annuity cut off of an insurance company that, I would argue, I have said for the last year or two, insurance companies are square in the target of a reset. If you see interest rates spike because of a dollar dump, if you think the insurance companies are scot-free, safe from all of that, I got a bridge to sell you. It ain't going to happen because they are loaded up with treasuries. They are very interest rate sensitive. So it's a dangerous thing, but what it is, it's an indictment of the system. These people running the pensions, they're actuarials, they're smart, they see where things are going, they see the trends, and the fact that you see 130% increase year over year. One of my very dearest friends, he's about 10 years older than me, but he was an executive at International Paper for a long time and has an amazing pension where he gets like $130 or $40 or $50,000 every single year. And if he dies, his wife gets it. I mean, it's crazy, but I remember him telling me, I don't know how many years ago, 7, 8 years ago, that he was the last year IP stopped doing pensions a while ago because these companies know. I mean, look at the pensions, the underfunding of pensions all around the world, all around the country, rather, in municipalities, in cities, and in corporations. It will lead to the downfall. Look at the police and fire and the teacher pension in Chicago. I mean, it's like 50 cents on the dollar funded. So pensions are a big problem, and to see them offloaded to insurance companies is only very logical, but it's an indictment of the system, and I think it makes the insurance companies who hold it that much more risky, if you will, from a forward-looking perspective.
Thanks for watching today's video. Let's quickly recap the key points. We're facing a 215 million ounce silver deficit in 2024, the second largest in over 20 years, and this doesn't even account for military demand. Meanwhile, countries like India and China are aggressively accumulating silver, with India seeing a 260% spike in imports month over month. These massive purchases are happening while banks suppress the silver price with huge short positions, setting the stage for major consequences. If you found this information valuable, don't forget to hit that subscribe button, give this video a like, and share your thoughts in the comments section below.